Well, hello ladies and gentlemen. Welcome to another video on my YouTube channel. This video is about a trade example, a trade taken on a very famous instrument called options. I'm sure many of you are aware of options, and there's a lot of debate which goes on. Is options selling better or option buying better? So we'll discuss those things. We'll discuss how I took a trade, what are the technical factors that I saw before I took a trade, what are the technical factors that I followed as I was in the trade, and why I exited the trade at the point where I exited it. Okay. Now, I personally believe that it is not just about sharing a profit screenshot. If you go to my social media, I have even bigger, far bigger amounts shared as profit screenshot, some way or the other. It makes people understand that, okay, fine, this guy can make profits. But I feel more than showing to the world what your profit screenshot is to cite the reasons why a trade was taken, the logic behind the trade, and whether or not the viewer, in this case the viewer of this video, that is you, can take the same trade. Now, coming to an understanding of what is the basic difference between trading futures and trading options. There is a difference. I also disclosed that while I was taking this trade, I was already long on the markets. From other than options, from other instruments than options, I was already long on the markets. So the quantity, as I said, is less. And the difference between futures and options trading, I will explain just now. So holding a position in a futures trend means that you're following the trend as time goes. So for example, there's an upward trending market and you want to hold on and make benefit of the entire trend or the maximum portion of the trend. Then you want to hold on to the trade, and you do so when you're taking that sort of a time in futures. It is completely fine, because minor corrections or sideways movements don't take away any kind of theta decay. Okay. Well, now coming to option, when you exit positions in a profit, okay, but in options, when you're buying options, here the assumption is the trader is buying options. When the position is exited in a profit in a short period of time, this means that you are allowing the market less time for theta decay. Knowing an instrument is very important before trading it. It is your hard-earned money, and if you have understood how this instrument is correlated with the price movement of the market, you have done something good for yourself. Secondly, risk decreases in the trend when the trend is in your favor in case of futures. Say for example, I bought a stock at 1000 rupees. Now I have a defined stop loss at 1080 rupees, 980 rupees. From 1000 rupees, the stock starts trending higher, and now the stock is 1035 rupees. I can place my stop loss at cost, and I can say that now my risk is minimum, my risk is at cost, so basically risk is zero, and this is the absolute risk. That means I should not be losing more money. Okay. Now the risk is linear in case of futures. Say for example, Nifty goes 100 points up, Nifty futures will go almost 100 points up, maybe a few points here and there, depending on the futures premium. In case of options, there is a non-linear relationship between the price and the instrument which is traded. So in case of options, if the Nifty goes 100 points up, the different Nifty call options of different strike prices will go up with a different magnitude. Now this different magnitude is called delta of an option, and this keeps changing. Okay. So so what happens is when you have bought an option and the market has gone increasingly in your favor, okay, at that time the delta of your option has increased. Therefore, any downtick in the market also will make your profitability decrease by a higher magnitude than it was at the beginning of the trade. So as the trade goes more in your favor, the option price definitely increases at an increasing rate, but your risk also increases at an increasing rate. Point number 3, there are no different types of future contracts. So basically, when we talk about futures contract, yes, there are different month contracts, like the current month, the next month, the month after that, but generally they have the similar aspect. The contracts are not too different from each other. They have a linear relationship with the market. In case of options, I'm in the money, at the money, out of the money, all these are different types of options. So for example, the Nifty is trading at around 16,000. The 16,000 call option or the 16,000 put option is the at the money option. Okay, if I say I'm talking about 16,400 call option while the market is at 16,000, then I say it is a out of the money option. When I'm looking at a 15,800 option while the market is at 16,000, we are talking about a in the money option. So higher the moneyness of the option is, the higher the delta is. Now there are other aspects to options than delta. There is theta decay, there is implied volatility, there is gamma, etc. In this particular video, I'm going to show you an option trade which I believe anybody who has less capital or wants to start with less capital in the stock market can take this kind of trade. The capital utilization on this trade is small. Okay. Now let's take a look. This is the particular trade I'm talking about, a trade on Banknifty options. Now this is an example of an out of the money option. This is an example of the 19th May expiry, and the trade which was taken on the 17th of May. Okay, so 19th May is just 2 days ahead. So point number one, the option is very close to the expiry, just 2 days. Okay. Point number two, it is an out of the money option. It is not very far out of the money, but it is relatively out of the money option. So this means that relatively out of the money options, we have got a cheaper premiums because the expiry is just 2 days to go. Also, you must notice that whenever you've traded, if you've traded these kind of options, the implied volatility has an impact on the option. If you look at it carefully, these are call options. That means money has been made while the market has gone up. In general, the implied volatility tends to go up at 2 times. One, when the market is there is some news about to come in the market is heated up with some expectations, and secondly, the volatility increases when the market is falling, and especially when the market is falling very steeply. In case where the market has gone steadily up, the implied volatility on options tend to decrease. This is a sign of stability and that there is less fear in the minds of the public, and they are implying lesser prices for options. Okay, so call options do increase, but the negative impact of a falling implied volatility is there. Also, just because 2 days is left for the expiry, we must understand that the theta decay is there. So 2 factors working against us. Now most people at this juncture end up thinking that if so many factors are against me, then maybe selling option is a better way to trade. Let me tell you very clearly, it is not the case. Obviously, the margin required is far bigger than you have in buying options. And lastly, if you are trading, if you're using futures, options, buying or selling them, either which way, you need to have a method to trade well. If you take selected trades and trade in options with a methodical way, you will end up making money, and if you do it with a proper psychological mindset, you will end up making money more consistently. Okay, so on buying options, this video is, and if you can see, this is a video, this is a trade which I took at 10:46 AM and 11:31 AM this trade is closed. So total of 45 minutes was the holding period of this trade. Okay, now let's look at the various time frames and the various things which were the part of the trade. Here is a basic profit screenshot, so to speak, where you can see the trade has been closed, and this was the position which is closed. This is particularly my options account, and we can see that there is a 7,820 rupees profit. If you want to calculate the amount which was required in order to take the trade, the capital utilization of this trade was around 11,000 rupees, and if you see that the profit which is taken is a significant great number, that is almost 80% or 75% profit of the capital utilization. Okay, now let's come to the logic of the trade. Okay, this is the chart of Banknifty, and if you can see, there is a very clearly defined line at around 33,818 levels which I have made. These highs are being broken in the morning itself. Now the highs did get broken, so that is one factor towards the positive end, that yes, the market is showing us a bullish undertone in the morning. But on the contrary, what happened is this gap zone got filled up to a great extent, and the market took some support again in this gap zone. Now there was a point where, if you notice in this next slide, where the market was actually hovering above this area, and it was showing us that yes, the market is now taking support where it took resistance yesterday, and today's high was about to be broken. Okay, so this was something which was on my radar, and these are the points of entry. Now looking at more specifically and going deeper only for today's day. Okay, this chart mostly has candles which represent today's day, and this was the area where the trade was taken. This is the entry zone. Okay, you see that after the correction over here in intraday, this correction, market has started to trend up. When the market has trended up, this is the zone where I use this correction to enter a trade. Okay, the trade entry were made on the calls at about 62.26 rupees, and after that I held on to the trade. The market went up steadily and then corrected a little bit and then gave another leg of movement, and this is the place at which I exited my trade. Okay, so you can clearly see that this is the way the trade moved. And if I look at the chart of the option, now something to notice, that the entry point is defined around 62 levels, as I said, during the correction. In fact, a little higher part of the correction only, if you can notice, this is the entry point. Okay, when the market made its first leg of movement, which seemed like a very fascinating wow profit immediately after taking the trade, I saw the profit. I did not book the profit because I was confident of the trend. The market went all the way up. The trade was, the option went about 84 rupees, and it corrected significantly after that. I held on to the trade, and much later, with the next leg of movement, I ended up booking the profits at the spike high. Now if you notice, the correction seems more mellow when we look at the particular chart of Banknifty, and the correction seems deeper when we look at the option chart. This is what the implied volatility is about. This is what theta decay is about. That as time is going forward, there is some theta decay which is happening on the option. So what tends to happen is that when I have taken this trade, I will see that okay, this option is trading at 62 roughly when I took the trade, then it goes a little down, then it goes a little up, and then I have to take these jitters, and this is where trader psychology comes in play. When these jitters on a trade are taken without emotions, and then the trend is followed. So my potential targets for the trade was that we should break above today's high and above the level which I have marked out around 34,000. Okay, so this is what I used as a matter of fact in order to my confidence in the wave counts which I saw. So I used Elliott wave theory. I used a little bit about my knowledge about options open interest, and the rest some other technical indicators also. This option video is particularly about the trade which I took and the psychology of the trade. The reason why I took an out of the money option was that out of the money option end up giving us a quick return on a swift price movement. So the swift price movement came in, and as you can see, I exited the trade at the high till that time of the day, and this high, which was around, the exit is around 106.95 rupees. So this high of around 107 rupees was not touched for a long time during the day. After that, the price corrected, and even though the price went higher, okay, later, the high was not taken out. The price was moving still around 97 to 100 rupees. Okay, so why is this happening? That even if the market is going higher, the call options don't end up making money after a certain point, because of theta decay, because of implied volatility falling. If you have an understanding and knowledge of options, you can make money if you combine it with technical analysis. To know more about me, to know more about what I teach, the courses and the personal mentorship program, you can log into www.technicallysorted.com. Thank you so much. Have a great day.